I am Reed. I am 27, just an average dude. IV made tons of money mistakes in my 20s, and now I want to share everything I've learned to help you take control of your finances and your life. Oh man, if you've ever felt a little bit uneasy, maybe even downright scared about your financial future, trust me, you are not alone in this. I've been there, stomach dropping, wondering if I was ever going to get my financial life together. It is a real struggle out there, and it is not just me and you feeling this. According to a recent study released by Allianz Insurance Company, the numbers are pretty alarming, like genuinely unsettling. They found that a massive 67% of Americans say they fear running out of money more than death, and 57% say they feel anxious when the market drops. Think about that for a second. More people are afraid of running out of money than they are of literally dying. Holy cow. That is not something we should just brush off. That is a deep primal fear. And these two stats, the fear of running out of money and the fear of market drops, they actually kind of the same problem, just showing up in different ways. It all boils down to uncertainty, to feeling out of control, because when you don't really know what your financial plan can support, how much you can safely spend without wrecking everything, or what in the hell happens when the market takes a dive. Every single dip in the market feels like a direct threat to your security, to your livelihood, to everything you've worked for. It feels like this might be the thing, that one market correction that breaks your retirement completely, and that is exactly where that crippling fear creeps in. It is when your future, your entire financial future, feels tied to something completely outside of your control. Whether that is the unpredictable market, the crazy economy, or just whatever scary headlines are popping up on the news cycle this week. So in this video, I want to do something very specific. I want to tackle these two massive fears head on: the fear of running out of money and the fear of a market drop, and I want to show you step by step how to significantly reduce them, how to almost eliminate them. I want to help you build a solid, actionable framework, a playbook that puts you firmly back in the driver's seat of your financial life, because you deserve to feel confident, not terrified about your money. So what actually reduces this fear? What can we as normal people with normal lives truly do to combat this deep anxiety? First and foremost, and this is probably the most impactful thing you can do, is having a written financial plan. If there is one single thing that could immediately reduce both of these fears, it is this, hands down. And the data, my friends, is incredibly consistent and absolutely screaming this truth from the rooftops. Research from major financial firms like Vanguard, Northwestern Mutual, and Charles Schwab all show the same thing. People with a written plan are 2 to 3 times more confident about their financial future. And here is the kicker: they are significantly more likely to stay invested during scary market downturns. They don't panic sell, they stick to the plan because they know what the plan is. But here is the problem, the big glaring problem. A shocking 48% of Americans don't have one. Seriously, almost half of us are just winging it. So just solving for this one thing alone, getting a written plan, could materially improve both of those alarming stats we talked about earlier. It could change lives. But wait, there is another problem, because it is never that simple. Right, most Americans don't actually know what goes into a comprehensive financial plan. We think planning is just saving money because, according to that same Allianz survey that we referenced at the start of the video, many don't know how to plan beyond just, oh, I'll save some money. Contributing to a retirement account is a great start, a really important start, but it is just that. A start beyond that, you also need a target retirement number. Like, what is your number? How much money do you actually need to have saved to live the life you want in retirement? You need a clear timeline for when you actually plan to retire, as well as a realistic timeline for how long you think that retirement will actually last. And here is a big one that people miss. You need a distribution strategy. This is crucial. How does this giant pile of money you've saved actually turn into income that you can live on? What does this plan truly look like in practice? Is it a monthly paycheck from your investments? Where is your emergency savings actually stored? And how much do you have? How are you covering any potential gaps between your income and your expenses? This is really truly how you turn mere savings into a real living, breathing financial plan. Allianz also pointed out that most Americans don't know how Social Security fits into their retirement picture. And this is a huge blind spot. If you haven't done so already, please, for the love of all that is financially holy, go to the Social Security Administration's official website, ssa.gov, and create your free account. Seriously, go do it right now after this video. Once you log in, you'll be able to see your entire work history. You'll be able to see what your projected benefits are at different ages, everything from early retirement age at 62 to full retirement age or age 70. And this information, this knowledge, can be incredibly empowering and help you decide when you are going to claim those benefits, because this is going to serve as your income floor. Think of it as a guaranteed base income. This is what comes in every single month, regardless of what the crazy market is doing, what the economy is doing, whether we're in a recession or a boom. And this is an incredibly important piece of this puzzle, because this shows you what your portfolio actually needs to cover. It shows you that your portfolio does have to cover 100% of your spending needs. That is a huge weight off your shoulders. Another major area of confusion, according to Allianz, is that most Americans don't know what taxes will look like in retirement. This is one of the biggest unknowns, and frankly, one of the biggest misconceptions out there. Here is the reality. And it might surprise you. Research from the Center for Retirement Research shows that the majority of retirees actually pay no federal income taxes. Let that sink in for a second. No federal income taxes, and we see a clear trend here. About 80% of households pay federal income taxes in their peak working years. That number dramatically drops to about 50% by the age of 65, and by the age of 70, it drops even further to about 35% of households. Why does this happen? Well, typically, income often declines in retirement. Social Security is partially tax-free for many. There are no payroll taxes in retirement for most people, which is a huge chunk of change. And many states have more favorable tax rates for retirees, where they eliminate or significantly reduce taxes on retirement accounts and pensions. So, for many retirees, taxes fall dramatically once they transition into retirement. But, and this is a big but, remember, not everyone fits this pattern. If you have very large traditional account balances, if you have dual Social Security benefits because both you and your spouse worked, or if you have a generous pension, you might not fit into this rosy picture. In fact, you may find that you stay in the same tax bracket or even move higher over time. So, what is most important here is that you know your specific situation. Don't just assume. Another big blind spot, another source of major anxiety is knowing what healthcare will actually cost in retirement. Oh man, this is one of the biggest sources of uncertainty and truly one of the hardest categories to accurately estimate on your own. It is like trying to hit a moving target in the dark. And this is exactly why IV partnered with a company called Chapter. Full disclosure, this is an affiliate link, but I truly believe in what they do and they are an amazing resource. Chapter is a Medicare advisory platform. They help you compare plans across all the major carriers, check if your doctors are covered, if your prescriptions are included, and basically find a plan that actually fits your unique situation. They help you project what your healthcare costs will truly look like in retirement, giving you some much-needed clarity. This is a huge piece of the puzzle that too many people overlook. So if you are approaching 65 or you are already on Medicare and you just want a second opinion or you are just confused about the whole thing, talk to one of their licensed advisors today. I have a link down below in the description box as well as a phone number if you'd like to reach out to them. They are a wonderful, wonderful resource that can genuinely ease a lot of your worries. Another powerful way we can really help to combat these fears of running out of money or fearing a scary market downturn is by thinking in terms of income-based planning versus what most people do, which is portfolio-based thinking. This is a really big one, a real paradigm shift, and it is supported by groundbreaking research from financial experts like David Blanchett and Michael Finke. When retirees think in terms of, I have a $400,000 portfolio, they often feel a lot of uncertainty with that number because a portfolio itself feels abstract. It is just a number on a screen. It is hard to think of a portfolio in terms of what will my actual life look like in retirement? What kind of life would that pile of money actually support? It is hard to connect the dots. But if we shift our thinking to thinking in terms of income, specifically guaranteed income as well as discretionary income, well then all of a sudden things feel a whole lot more concrete, a lot more tangible. Let us run through a quick example to make this super clear. Let us assume we have a dual income household. One person receives $1,600 a month in Social Security benefits, and the other receives $2,500 a month. That is a total of $4,100 a month in guaranteed income. So no matter what the market does, those checks show up every single month, like clockwork. That is your base. Now, let's say this household also has $400,000 invested in their portfolio. At a conservative 5% withdrawal rate, that gives you $20,000 per year, or about $1,700 per month. That $1,700 per month becomes your flexible income. This is the part that you can adjust and control. Maybe you spend a little bit more of this when the markets are doing well and you are feeling good, and maybe you pull back a little bit when the markets are down and you want to be more conservative. Now think of how dramatically different that feels from just looking at a $400,000 lump sum. In one scenario, you say, I have $400,000. What kind of life can I have? It is vague. It is scary. In the other, you say, I have $4,100 a month in guaranteed income plus about $1,700 a month in flexible income. That gives you a real, tangible picture. That is something you can truly plan around, something you can build your life around. And it is very easy for us to work with monthly income figures. After all, we've been doing this our entire working lives, managing our paychecks, and this is exactly what the research shows. When people frame their wealth as income as opposed to abstract assets, they experience more stability, more control, and way more confidence. And more importantly, they feel less anxious and more comfortable actually spending their hard-earned money. It is a game changer. The next thing you absolutely need to do, the next piece of this financial freedom puzzle, is to understand safe withdrawal flexibility. One of the biggest fears that looms over pre-retirees' heads, and it definitely loomed over mine, is the terrifying thought, what if I retire and suddenly the market drops? All of a sudden, everything I worked so hard for, my entire retirement plan completely breaks, unravels. But, my friends, that is not how a well-designed, robust retirement plan actually works. Research from powerhouses like Morningstar, Vanguard, and financial planning guru Michael Kitces shows that the famous 4% rule, often cited as the safe withdrawal rate, is a conservative baseline based on rigid, inflation-adjusted withdrawals, meaning you take out the same amount every single year, adjusted for inflation, no matter what. But here's the key. Real-world retirees aren't T-rigid. Life happens. When you introduce even basic flexibility, the starting withdrawal rates can actually increase to about 5% to 5.7%, and get this, the long-term success rates of your portfolio improve significantly. And this doesn't mean dramatic, painful lifestyle changes. In many situations, it is as simple as skipping an inflation raise in your withdrawals for a year or two, or reducing your pull from your portfolio by a small 5 to 10% temporarily during a downturn. Let us use our previous retirees who had that $400,000 portfolio. Let's say you are withdrawing $1,700 a month or $20,400 for the year. Let's say you reduce that draw by 10% during a market downturn. So now you are pulling $1,547 per month or $18,564 a year. That is a reduction of about $1,800 per year. That is only about $153 a month. We are not talking about a massive, painful change here, are we? If we look at it on its face, it doesn't even feel like much of a sacrifice. And remember that this household would still have those rock-solid guaranteed income streams, like Social Security, coming in every single month, providing a strong base. But when we make small strategic adjustments like this in the times where it matters most, research shows us that this can have a long-term, outsized, incredibly powerful impact on the success and longevity of our portfolio. Adjustments like this can improve success rates by a whopping 10 to 20 plus percentage points. It can preserve tens of thousands, maybe even $100,000 or more in portfolio value over the long run. And it can extend the life of a portfolio by years, sometimes many years. The benefit isn't really just about the dollar amount saved in that moment. It is about when you make the change, when you reduce your draws, when the market is down, when your assets are depressed. You strategically avoid selling when it could do the most permanent damage to your portfolio. Instead of locking in those losses, you give your portfolio the crucial time it needs to recover, and more importantly, this gives you a specific, clear plan that you can follow should this situation happen when you retire. And having a plan, having a playbook is everything, because then you know exactly what to do. You are not panicking. So the bottom line is making these small, temporary, flexible adjustments can result in a permanent, massive improvement in the health and longevity of your portfolio. Number 4, and this is a big one for peace of mind, is building a cash buffer. This is your sequence risk protection, your financial stress shield. This is one of the most practical, immediately anxiety-reducing ways to approach retirement. And the idea is very well supported by research. You want to have anywhere from, say, 3 to 5 years worth of cash at the ready, sitting in an easily accessible place, whether that is held in a money market fund, CDs, short-term T-bills, something that is liquid and safe. What this does is it completely eliminates the need to sell investments during a market downturn. It protects you from sequence of returns risk, that nasty risk of having to draw on your investments early in retirement if you happen to retire into a down market. And it turns scary market drops into really a non-event for you because you are not touching your main investment portfolio. So instead of thinking, oh my goodness, the market is down, what am I supposed to do? My life is over. You get to calmly say, oh, the market is down. It is okay. I don't even need to touch my investments right now anyway. I've got my cash buffer. It is incredibly empowering. But this might also lead to you thinking, Reed, how in the world am I supposed to build a cash buffer that is 3 to 5 years worth of expenses? That sounds like an astronomical amount of money. Well, the good news, my friend, is you don't have to cover all of your expenses. You only have to cover the gap between your necessary spending and your guaranteed income streams. Let us go back to our dual income household example. They have $4,100 a month coming in from Social Security. This is their guaranteed income. Then they want $1,700 a month from their investment portfolio to cover their flexible spending. That $1,700 a month, that is the gap. Instead of building a cash buffer that covers their total spending, which would be $5,800 a month, you are only building a buffer that covers that $1,700 gap. So, in this situation, a 3-year buffer looks like about $61,200. Now, sure, that is not an insignificant amount of money, but what this does is it gives you multiple years where you literally don't have to touch your portfolio. You don't have to sell during a downturn, and you can give your portfolio the crucial time it needs to recover and bounce back. It is your ultimate safety net. Number 5, and this is so important, we want to allow Social Security to truly serve as our foundation. Look at it as our income floor, our bedrock. This is one of the most underappreciated stabilizers in retirement, especially for normal folks like us. According to data from the Social Security Administration itself, low earners experience about a 75% income replacement from Social Security. Middle income earners tend to fall in the ballpark of about 40% as an income replacement. And if we look at married couples, they see income replacement for the household level of about 62% of income. If we look at households without a traditional pension, these are not trivial numbers, my friends. These are substantial amounts of money that can cover a significant portion of your living expenses. And once people truly understand what their projected benefit looks like, they can plan out when they should actually claim, and they can figure out exactly how Social Security fits into their whole retirement income picture. And this changes everything, because now you know your investment portfolio doesn't have to carry the full burden of your retirement. It is not all on your investments. And then it is important that we also layer in two more realities. First, many retirees actually spend less in retirement than they did while working. Your work expenses disappear. You have more time to do things yourself. Your housing might be paid off. And second, Social Security can cover a meaningful portion of income, especially for lower and middle income earners. All of a sudden, that gap you need to fill from your investment portfolio starts to feel a lot more manageable, a lot less intimidating. For instance, if you expect to live on $60,000 a year in retirement, and you only need to cover 20% of that gap from your portfolio, or about $12,000, that feels a heck of a lot more manageable than thinking you have to cover the entire $60,000 from your investment portfolio alone. Truly, for most Americans, Social Security is the income floor that your entire retirement plan ends up being built on. It is your anchor. If you take everything we've just walked through and actually put it into a coherent, actionable plan, your entire experience of retirement changes completely. First and foremost, having a written financial plan, a literal document that outlines your goals and strategies. Second, having clear, defined income floors, looking at Social Security, perhaps a pension or an annuity, anything that provides guaranteed income. Third, having a flexible withdrawal strategy, so you know exactly where and how much you cut in a market downturn without panicking. And fourth, having a 3 to 5 year cash buffer, which lets you know that you have money set aside ready to turn to if needed, completely changes the game. Now, if you experience a market drop that doesn't feel threatening, it doesn't feel like the end of the world, because now you simply turn to your plan and you know exactly what steps to follow. You already know where your income is going to come from, how much you can adjust if things get tight, and what parts of your investments you are absolutely not going to touch. This is financial empowerment. So, to circle back and answer our question at the top of the video, what could realistically improve these alarming stats we referenced? If we strip everything down to the highest impact, most effective actions, it comes down to 3 core things. Number 1, get people to create a written plan. This alone, just this one step, can dramatically reduce fear, because uncertainty, that paralyzing unknown, tends to disappear when you have a clear, actionable plan in front of you.